Bitcoin plunged sharply yesterday. Here's the concise breakdown of what likely triggered the crash. For those of you tracking the markets, the volatility was significant. As of this recording, the price of Bitcoin is hovering around $111,163. The intraday range tells a story of its own, with a high of $117,099 and a low reaching down to $105,262. That's a drop of $5,713 or about 5% from the prior day's close. In moments like these, separating signal from noise is crucial. The digital asset space is often filled with hyperbole and speculation, but our goal here is to cut through that. We're going to look at the facts, the data, and the chain of events that culminated in this significant downward pressure. It wasn't one single event, but a confluence of factors, a perfect storm, if you will, that hit the market in rapid succession. Understanding these individual shocks helps to form a clearer picture of the market structure and its inherent sensitivities. We will methodically walk through the key drivers, from geopolitical tensions, macroeconomic shifts, to the internal market dynamics of leverage and sentiment. This isn't about predicting the next move, but about understanding the last one with clarity and precision. The aim is to provide a measured, factual analysis to help you make sense of a volatile day in the crypto markets. Let's get started. The first tremor was felt not in the digital world, but in the physical one, originating from the persistent friction between global superpowers. Reports began to circulate of a sudden and severe escalation in U.S.-China trade tensions. Specifically, sources indicated the potential imposition of a 100% tariff on critical software imports from China. This wasn't just a minor adjustment, it was a significant policy shock. In an interconnected global economy, such a move immediately raises the specter of retaliation and broader economic disruption, creating a classic risk-off environment for investors. Assets perceived as higher risk, like cryptocurrencies and high-growth tech stocks, are often the first to be sold when this kind of uncertainty emerges. The news spooked markets across the board. We saw an immediate flight to safety, with capital moving towards traditional havens. For Bitcoin, which many proponents argue is a safe haven itself, this event proved it still behaves largely as a risk asset in the eyes of institutional capital. The immediate and sharp selling pressure that followed this announcement was the initial catalyst that set the stage for the declines to come. While the geopolitical news provided the spark, it was the high levels of leverage within the crypto market that acted as the gasoline. The initial price drop, though significant, was dramatically amplified by a wave of forced selling. In the hours that followed the trade war news, we witnessed a cascade of liquidations. Over a 24-hour period, data shows that more than $19 billion worth of leveraged crypto positions were wiped out. These weren't discretionary sales. These were forced closures of accounts that could no longer meet their margin requirements. This process is known as a leverage unwind, and it creates a vicious feedback loop. As the price falls, long positions, bets that the price will go up, are automatically liquidated, which means the underlying assets are sold onto the market. This new supply of assets for sale pushes the price down even further, which in turn triggers the next threshold of liquidations at a lower price point. This self-reinforcing cycle explains why the price drop was so swift and severe. The sheer volume of forced selling overwhelmed any buying pressure, turning a dip into a crash. Context is important. The market didn't enter this event from a position of weakness. Quite the opposite. In the days and weeks leading up to the crash, Bitcoin and the broader crypto market had experienced a significant rally. Technical indicators, such as the Relative Strength Index, or RSI, were flashing overbought on multiple timeframes. This simply means the price had moved up too far, too fast, and was statistically likely to see a reversion or a period of consolidation. The market was, in a sense, primed for a pullback. When the negative news hit, it provided the perfect catalyst for traders who were already sitting on substantial unrealized gains to take profits. This wasn't panic selling, but rational decision-making. Seeing the initial dip and the concerning headlines, many decided it was time to lock in their gains before the rally reversed further. This wave of discretionary selling from profitable traders combined with the forced selling from liquidated longs, adding significant downward momentum and ensuring that any attempt at a bounce was quickly sold into. It was a textbook example of sellers overwhelming buyers. Another contributing factor, more subtle but equally important, was the shifting demand from a key new source of capital, spot Bitcoin ETFs. Since their approval, these ETFs have driven price gains, channeling billions into Bitcoin. In the days before the crash, data showed a noticeable slowdown. Reports surfaced of weakening net inflows. On some days there were even net outflows. That was a big change to the market's underlying bid. Less fresh buying left the market more vulnerable. Think of it as a support structure being removed. When ETFs had massive daily inflows, that capital acted as a buffer and absorbed routine selling. With that buffer diminished, the market's foundation was less stable. Then geopolitical selling began. Then leverage-driven selling kicked in, and there was far less passive buying power to absorb the shock. The absence of strong ETF demand gave price a clearer, faster path downwards, Beyond the world of crypto, the broader macroeconomic landscape was also becoming less favorable. A key indicator to watch is the yield on U.S. Treasury bonds. These are considered among the safest investments in the world. Recently, these yields have been climbing, driven by stubborn inflation data and a corresponding shift in expectations for Federal Reserve policy. Hopes for imminent interest rate cuts began to fade, which would have made borrowing cheaper and risk assets more attractive. The market started pricing in a higher-for-longer interest rate environment. When you can get a higher risk-free return from a government bond, it changes the calculation for investors. The opportunity cost of holding a volatile, non-yielding asset like Bitcoin goes up. Safer yields in the traditional financial system become relatively more attractive, and this can pull capital away from riskier markets, including crypto. While this is a slower-moving, more foundational pressure, it contributes to the overall environment in a meaningful way. The confluence of these factors created what is known as a cascade effect. It's a chain reaction, where one event triggers another in a rapid downward spiral. It began with the geopolitical news causing an initial price drop. Initial drop. This drop then triggered the first layer of automated stop-loss orders. Stop losses. Preset sell orders placed by traders to limit losses. This first wave of automated selling pushed the price down further. Fast. That's when the margin calls began in earnest. The lower price meant leveraged traders were now underwater, and their brokers demanded more collateral or forced them to sell. This is the liquidation process we discussed, but the key here is its cascading nature. The liquidations from the first group of traders pushed the price down to a level that triggered margin calls for a second, larger group. This second wave of liquidations pushed the price lower still, triggering a third. It's a brutal, mechanical process that feeds on itself, accelerating the drop far beyond what the initial news alone would have caused. Ultimately, a market is a reflection of human psychology, and the sentiment in the crypto market is notoriously fragile. Unlike mature markets, equities, bonds, which are anchored by fundamentals, earnings, cash flows, crypto prices are heavily influenced by narrative, momentum, collective belief. This makes the market highly susceptible to sudden shifts in mood. A sharp policy announcement, a negative macroeconomic shock, can trigger a disproportionately large reaction from traders, investors, conditioned by years of volatility. This fragility was on full display. The trade war headline was the pin that pricked the balloon of optimistic sentiment that had been building during the preceding rally. Once fear took hold, it spread quickly through social media and trading communities, reinforcing the negative price action. Investors who might have otherwise bought the dip held back, waiting to see where the bottom was. This absence of confident buyers, combined with the aggressive, forced selling, created an air pocket in the market where the price had little to no support. A final point on the mechanics of this crash comes down to the concentration of risk. It wasn't just that there was a lot of leverage in the system. Many traders were using similar strategies and had similar positioning. The preceding rally had created a consensus long trade. A large portion of the derivatives market was betting on continued upward movement, often using the same popular exchanges and similar levels of leverage. Their stop losses were likely clustered around similar technical levels, and their liquidation points were also in a concentrated range. Instead of a diverse market with buyers and sellers on both sides, the market became dangerously one-sided. Everyone was rushing for the same small exit door simultaneously. This concentration of leverage and positioning amplified the crash risk exponentially, as the simultaneous forced exits created a liquidity vacuum. So, to recap, this wasn't a random event. It was a chain reaction. Text overlay: 5 shocks, geopolitics, leverage, liquidations, ETF flows, macro